Welcome to this deep dive into one of the most influential investment books of all time, The Intelligent Investor by Benjamin Graham. Published originally in 1949, this masterpiece has stood the test of time and is widely regarded as the Bible of value investing. Warren Buffett, one of the world's greatest investors, calls it the best book about investing ever written. But this book is more than just an investment guide. It's a manual for rational thinking, financial discipline, and long-term wealth creation. Whether you're a beginner or a seasoned investor, the timeless wisdom in this book will sharpen your financial instincts and help you make better, more informed decisions. Benjamin Graham was a legendary investor, economist, and professor at Columbia Business School. He's best known as the father of value investing, a philosophy that encourages buying undervalued stocks with strong fundamentals. The Intelligent Investor teaches how to think critically about risk, market behavior, and personal finance. Rather than quick riches or speculation, Graham promotes patience, discipline, and a commitment to long-term value. First investor versus speculator. Graham makes a clear distinction between an investor and a speculator. An investor carefully analyzes a company's value, seeks a margin of safety, and aims for long-term results. A speculator guesses or bets on price movements, often based on emotion or market trends. Example: if you're buying Tesla stock just because it's trending on social media without understanding the company's fundamentals, you're speculating. But if you're evaluating its earnings, market position, and long-term growth, you're investing. 2. Margin of safety. This is one of the most critical principles in Graham's philosophy. The margin of safety is the buffer between the intrinsic value of a stock and its current market price. Practical tip: if a company is worth $100 per share based on its earnings, but you can buy it for $70, you have a margin of safety in case things don't go perfectly. Mundra Murther Market, the emotional partner. Graham introduces a fictional character called Mr. Market, who represents the stock market's mood swings. Every day, Mr. Market offers to buy your stocks or sell you his at different prices. Sometimes he's excited and prices are high. Other times he's depressed and prices are low. Morale: don't follow Mr. Market, exploit his irrationality. Buy when he's fearful and sell when he's greedy. 4. The defensive versus enterprising investor. Graham defines two types of investors. Defensive investors seek safety and stability. They prefer blue-chip stocks, bonds, and diversification. Enterprising investors are willing to put in extra effort to find undervalued opportunities in the market. Example: if you're working full-time and want your investments to grow steadily without constant monitoring, be a defensive investor. If you love researching stocks and have the time, go enterprising. 5. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. Benefit: it protects you from investing too much when prices are high and too little when they're low. Over time, you buy more shares when prices are down and fewer when prices are up. 6. Don't time the market. Graham strongly warns against trying to predict market highs and lows. Even experts get it wrong. Instead, build a diversified portfolio based on your risk tolerance and stay committed for the long haul. 7. Intrinsic value versus market price. Just because a stock is priced at $500 doesn't mean it's worth that. The intrinsic value is what a company is truly worth based on its assets, earnings, and growth potential. Takeaway: smart investors always focus on value, not price. Real-life applications: before buying a stock, research its fundamentals. Earnings, debt, leadership, and competitive advantage. Don't let emotions drive your decisions. Stick to your strategy even when the market panics. Use index funds or ETFs if you're a defensive investor seeking reliable growth with low maintenance. Conclusion: The Intelligent Investor by Benjamin Graham isn't about beating the market overnight. It's about building a mindset of patience, discipline, and analytical thinking. In a world full of noise, speculation, and hype, Graham's timeless principles remind us to stay grounded in reality. Remember, investing isn't about being clever, it's about being wise. If you take the time to understand this book and apply its lessons, You'll not only become a smarter investor, you'll become a more thoughtful, strategic thinker in all aspects of life. Let us know in the comments. What's your biggest takeaway from Benjamin Graham's wisdom? Be part of our journey. If you find our content valuable and inspiring, don't forget to subscribe to the channel and turn on the notification bell to stay updated with our latest videos. Your support motivates us to keep going and bring you the best content, so don't forget to leave a like and share the video with those who might benefit.